there was some rock and roll. And it was all there.
Any good 70s music?
Yeah. Yeah, and then Tuesday night, we went to a reception that was part of the conference, and they had a band that was in there playing mostly 70s and 80s.
I was in a band in the 70s, late 70s.
Yeah.
Gosh, it was great.
And they were really good, like really high energy, get after it type of stuff. Really, really good. Hi, Dan.
Oh, there we go. Hi, how are you?
Hi, Dan.
Howdy. I got Dennis. Who else is here?
So I'm not sure who iPad is. If you could identify yourself, that would be great. I think it's Pam.
Tom Kavarik, I'm here.
Oh, Tom.
And Frank.
Hey, Frank.
Ah, it is Pam. Okay. I thought it might be.
Good.
Dennis.
Yeah, I'm gonna make you co-host here so you can share your screen.
Oh, good. Thank you.
Think.
Yeah, it's still not working.
Hold on, I'm getting there.
All right, now I got it. Yeah. All right, good. Can everyone see that?
Well, everybody has a computer. The two guys in here don't have computers, so I'll look over there. I'll swing it around and you can all see it. So we're good, Dan. Everybody can see it now.
I'm looking at
Okay.
your, I've got that. I've got your deck.
Oh, good. Okay. I didn't know you were going to be up there, Frank, in person.
We don't want to make it difficult for you.
Oh, I would have come up. I assume Pam's in person as well.
She's online with us.
Oh, she's online. Okay.
Yeah.
All right. Let me know. Are we ready to go?
Sure. I think so. Yep.
All right. Good. Let's see. All right. Jump right into the asset allocation as of the end of Q3. obviously the end of your fiscal Q1. Just under 15 million, and we're sitting at a 70-30 allocation. Cash is 9%, but when I say cash, obviously I mean money market funds. We're invested in the money market side of things in a treasury money market fund, which is paying us just north of 5%, I think 5.05. We keep the treasury money market funds. They have a little bit lower yield than the traditional money market funds that have corporates and certificates of deposit and bankers acceptances and those things, simply because the extra maybe 10 or 15 basis points isn't worth the risk. As you know, money market funds can now float. They can break the buck, if you will. And I'm not suggesting that they would, the money market funds that we use, but as a practical matter, back when the banking crisis, if you will, that we had back in March, when Silicon Valley Bank and First Republic and went under, and then some others were solvency were questioned, we were a little bit worried about stretching for that extra 10 or 15 basis points. So we moved everybody over to treasury money funds. So again, a little bit less of a yield, but at the end of the day, it helps us sleep better. So I think it's worth it. Jumping right into the account performance. And again, now I'll focus on the total account return, and then we'll move up to the equities because that's where the lion's share of the returns come from. So end of the fiscal first quarter, you can see the account was down 0.87%, so call it 0.9% decline against a decline in the benchmark of 2.5%. And that was driven mostly by the decline in equities, obviously. So ahead of the benchmark on the total return, obviously by a fair amount. And then the managed equity returns at negative 1.74 against an S&P 500 of decline of 3.27%. So now most of this is a function of the fact that we all probably have heard about the Magnificent Seven and the concentration in the performance of the S&P, really 7 to 10 stocks. And they've started to come back to earth, if you will, mean revert. So the first 6 months of the year were pretty ripping in the S&P, and a lot of those large cap tech companies have done very well. But again, some of the air started to come out of that balloon, so those returns are coming back to us a little bit. You can see that now in the previous 1 year return number. Total account return year over year through September, 10.15, slightly below the 10.98, call it 11% of the benchmark. And again, that's a function of the fact that we underperformed the first 6 months of the year because the equity markets were pretty frothy. So we're not going to chase those returns just to try and keep up. So there are a lot of stocks that we didn't own that did very well. But again, at the end of the day, we've got to be comfortable with our valuation, protocols and what we're okay with investing in. But the year over year, the equities in the portfolio still did pretty well, 13.6% versus 15.95 for the S&P. So again, slightly below, but in the ballpark again, given the robustness of the returns over that previous 12 months. 3-year annualized numbers, you can see we're nicely ahead, 687 annualized versus 584. So a full percent every year for the last 3 years. And then slightly ahead on the managed equity side, 1070 versus a 10.53 up here above the total return. 5-year numbers, things spread out a little more, 827 annualized for 5 years. Again, this is consolidated versus a 7.1% return for the benchmark. And again, the benchmark is a static benchmark, a 70-30 mix, just like we are. In the equities, annualized equity return for 5 years, 11.72 versus 11.12. And then inception to date from August of 2010, 7.8 versus 851. You guys have heard me say this before. We're under there, even though our equities are ahead, because it was 6 to 9 months before we began investing in equities in the portfolios. They were all short-term bonds and certificates of deposit at that time that we took over the portfolio. But we're 13 years into it now, and things look pretty solid across the board. So real dollars. Oh, sorry, go ahead.
Just still shaking my head, 13 years.
What's that?
I'm shaking my head, the idea it's 13 years.
I know. Me too, Frank. Oh my God, it's crazy. Yeah, my daughter's a freshman in college. She was 5 years old when we started running this money. So time marches on. So real dollars, pretty impressive for the town. Again, you have to tip your hat to the committee that was formed 13 years ago, 14 years ago, that basically said we've got to change the dynamic in the way that the town monies were invested. You can see in 2010, we started out on a consolidated basis with just under 12.1 million. Over that period, we've distributed 11.2 million. We have investment gains of nearly 14 million over that period. We're just under 15 million in investment value. So again, we've talked about it in the past. Eventually, this distribution line will outstrip our original contributions. But again, thankfully, since you have critical exposure to equities, you can see this red line. This will eventually decline below the original invested capital amount of 12.1 million. So again, the approach that the town employed all those years ago have really saved the fiscal house, if you will, for the town of Wiscasset. And this makes that very obvious. Now, we all know that in the last several years, or maybe the last 5 years, I guess, distributions have been quite a bit higher than the investment policy goal is, the stated goal of 3.5%. And I understand that municipal finances are tough, and we don't want to raise property taxes and a lot more. Everything's going up in price, but this is an example of a disciplined approach, but again, we're probably outstripping the annualized 3.5% approach or goal that we've had again since inception. And I think Pam was around for that time too, the beginning of this whole experiment.
Yep, Pam's been here before, you bet.
All we
Yes,
need is
I
Ed
was here
Pilarczyk.
when you did that.
That's right. We're missing Ed Pilarczyk and Steve, and maybe that was the group. So as you know, we manage based upon characteristics. So here's our characteristics summary for the portfolio as of 9/30. Again, these are the characteristics that matter to us and that really drive the returns in the portfolio. So you can see up here in the summary that we're comparing the account equities against the S&P 500 as the benchmark. Price to earnings multiple is less expensive than the S&P. More in line with kind of a terminal or a historical rate of price to earnings multiple. The S&P is somewhere in the 15 range over the longer term. You can see the S&P at 19.6 as of 9/30 is pretty expensive relative to that long-term run rate. Dividend yield right in line. A payout ratio, again, lower is better. It's percentage of earnings, profits that get paid out in the form of dividends. The lower number allows the companies to grow those dividends over time. So the GOI characteristics or the growth of income characteristics in the portfolio from equities is very strong. And again, return on invested capital. This is a very large number relative to the S&P. So it's important for us to invest in companies that not only earn their cost of capital, but earn a good return over their cost of capital, and then can compound that over time. And those companies tend to outperform over the longer term, and they also not just pay a dividend, but they grow those dividends over time, and that's what we want. Long-term debt to capital, lower number is obviously better, a lower debt ratio than the broader market. And this all translates into a 0.84 V ratio against the S&P 500. So the real takeaway here, the portfolio looks really strong relative to the S&P, but what you should take away from this is the S&P as of the end of the third quarter was quite expensive, in part because, again, it's a capitalization weighted index. So the bigger the company, the more impact the return it's going to have on the index. So a Microsoft or an Apple or a Tesla, again, part of that magnificent seven, if you will. So those stocks are expensive, and we believe that the S&P has further to fall. I mean, it's been it was a difficult September for the S&P, and so far in October it's been about flat, but there's a lot of volatility. We're staring down significant increase in interest rates, and I don't really have any reason to believe that the longer end of the curve is going to decline. I think it's going to continue to rise, maybe not all at once, but it would surprise me to see a 5% 10-year pretty soon. I mean, we're obviously on the short end of the curve in the 1 month to the 1 year range. We're trading at 5.5, so we're still inverted, but much less so than we have been over the course of the year. So the long end of the curve, the longer bonds are closing that gap, and I think eventually you'll get things. The curve will become normalized, and you'll get that 10-year above that 5 to 5.5 range, which is quite a bit higher than where we are right now.
This is Tom. When you mentioned further to fall, S&P 500, you think 3,800 is doable, or you think even lower?
Well, I can't say that I've got a number in mind, but I wouldn't hurt my feelings to see the market come back to something more closely approximating a long-term price to earnings multiple, which again would be somewhere in the 16 range. I think that might get us down to the 30. Did you say 3,800 or 36?
I said 38. I'm just throwing it out there.
Yeah, I mean, that's not unreasonable. Where are we right now? I think we're around 40, 43, 44. 42.60. Yeah, that's not unreasonable. I mean, it's going to be a function, at least in the near term. It's going to be the market movement is going to be a function of rates and how quickly those rates move up. I'm hard pressed to think that. I think right now on the bond side, the reason rates have risen so quickly over the last month or so is you really don't have anyone out there willing to buy. So there's really no bid. So call it a buyer strike, if you will. But, people want to be compensated for, if you've got inflation running stubbornly high, let's just say it's in the 4% range, or 3% if you want to factor out food and energy. I still think that 3% number is, I think you're closer to 4. I think it can, oil's taken a hit in the last few days, but oil at the end of the day is an input cost for just about everything. So I think the numbers that we're going to see coming out in the fourth quarter from an inflation standpoint are going to be higher. Food prices are obviously higher. As if you're going to be sitting on a 4% inflation annualized number, I know the Fed wants to get it to 2, but if you're at 4%, it's awfully hard to buy a 30-year 4% piece of paper or 4.5, unless you think that we're going into a recession and interest rates are going to collapse. And I really don't see, outside of some kind of Federal Reserve interference, I really don't see that happening, because at the end of the day, you've got to pay for that added duration risk. And inflation is having a real live impact on earnings. So the short answer is yes, we could see that.
The original number that you said started off with years ago, what was that number that was in the portfolio?
12.1 right here on this page. Inception.
And we're at
14.8.
okay. So our purchasing power is certainly diminished by inflation over those 13 years due to the withdrawals, I guess.
Right. Well, inflation and withdrawals. Yeah. I mean, that's the thing. I mean, we, at the end of the day, again, this money would have been gone several years ago. It would have been completely depleted if the allocation had remained the same and basically money markets and short-term bonds. But so you've still got that money, but you're right, on an inflation adjusted basis, it's a much lower number. But again, that's why the spending bogey in the investment policy is so important. I mean, at a 3.5% average draw rate, if you have 3.5% and you add 3% inflation to that, that's 6.5% to keep you even. And then we're at 780. And so let's say 3.5%, let's say 3%, a 3.5% draw would get you to 6.5, and that would give you 1.3%, 1.5% real life growth over and above inflation in your draw, and that's kind of the goal. But this number it's 11.2 million is much higher than 3.5%. So you're probably right about even with not just your draw, but also inflation, maybe a little underwater from a purchasing power standpoint. But again, that's all about the spending.
The purchasing, the withdrawal rate, is that against the entire portfolio, including the dedicated funds, or are we, are we withdrawing against only the funds that are not dedicated, like the Barney and the music fund, et cetera? Is that our percentage that we're taking out? Are we projecting that against the entire thing, including
well, the endowment, obviously, I mean, the endowment funds they have a much lower draw rate than the reserve funds. So, I mean, that is a little bit of a problem, because at the end of the day, I think there are some endowment funds that you can't even begin to spend the money that's in there. But the reserve funds are a little more fungible, if you will, and help to offset operating expenses of the town. So the reserve fund has probably been depleted more, not just on an absolute basis, but obviously on an inflation adjusted basis as well. But we track it on a consolidated basis because it just makes it easier to track, and you get the big picture that way.
I understand that. I just wondered what our withdrawal rate against the reserve funds has been.
Well, I mean, that would be a calculation that I think Dennis's office could do, or we might be able to go back in time and work on that. But I'm guessing it's closer to 5% than 3.5%.
Well, it's a nice bogey, because you use your word, $4 million in what you would consider the restricted funds. I just wish there was some way we could either be very liberal in our description of what we're doing and the purpose of the funds coming out to give us access to that big number sitting there.
Right. Well, again, maybe, I'm always happy to come up and talk to the council and sit down and participate in any workshops, or maybe we could do, a little bit of forensic analysis, and compare the endowment draws to the reserve fund, and see if there's any way to maybe shift some of what would be the endowment funds to traditional kind of reserve expenditures. However, the reserve funds are able to be invested this way, again, because of Title 30A and the specific nature of the categories. Obviously, capital expenditures and tax reserve funds, that type of thing. But we could go back over that again, have a little educational session for the council, or sit down and talk about it as a finance committee. But again, I'm available anytime to talk about it. So,
and I think we've talked about this before, Dan, particularly with that Larrabee fund that hovers right around $1 million. But the language in that fund is so very specific as to what can be done with those funds that I think we'd have to get a judge to agree to amend that.
Yeah, so with some of the endowment funds, we can talk about that in the context of the statute known as the Uniform Prudent Management of Institutional Funds Act. So we can talk about that. But some of those endowment funds are probably restricted enough that you might have to go in front of a court or get an order allowing the funds to be spent a little more liberally. Because the one thing the courts don't want to allow or have happen is to have the purpose of the endowment itself defeated essentially by overly restrictive measures that basically prohibit you from accessing the money. The courts don't want that. It doesn't make any sense. So they might be amenable to that, but we'd have to go through those accounts one by one and have a conversation about those.
I haven't been through all of them, but I know this comes up from the school every year. They just this past Tuesday put in a new request for funds out of there for a whole bunch of instruments and things for students, and it's still only $5,000. That thing's got $1 million. They'll never spend that in anybody's lifetime.
Right.
But again, the language is very specific. If there's no ban, the money must sit there and draw interest. So I guess my thing was, can they expand that program up there, and instead of just having just band, expand it into performing arts?
Right.
That they could have a little more liberal use of that money for, theater or something along that lines, instead of just specifically a band.
And that would help offset some of the expenses for that from the general fund, right?
But and it would on the school side. But I mean, that money's just sitting there, really, it's not doing anybody any good.
Right.
It's just doing no good whatsoever.
It is absolutely no use.
It is. It's an asset that we're just simply staring at every month and saying, oh, this looks great, but we can't do any good with it, so.
That's right, at a selectmen meet, they see that the number is now $14.8 million, but in fact, 40% of that is gossip. We can't get that $4 million.
Right. Well, that, there's at least $1 million of it that we could be doing something with. And it's the same with the cemetery funds. I mean, those keep increasing in value every year, and, you know, we don't spend those. So I think there is a conversation that needs to be had here. And since I was kind of saving this for the end, but I guess I can bring it up now. The town's cash position right at the moment is really very strong. Our fund balance several years ago was like $100,000. And I haven't seen this year's audit yet. We'll have it sometime in our hands next month. But we're sitting somewhere north of $4 million in our fund balance now, which is gonna, and taxes are starting to come in. So by the end of November, I could be sitting on almost $10 million in cash. And some of that could probably now start being filtered back into this investment fund, because we don't need to be sitting on $10 million in our checking account.
No, right. I mean, and we can, I don't know if we talked about this in the past, but if you want, I mean, we're happy to set up a separate account to help you manage the cash. I mean, money market funds and short-term treasuries they're risk-free returns, and they're a real asset class now. I mean, they haven't been an asset class for years, but if you're pulling in 5 and 5.5 on a 1, 2, and 3 month treasury, you don't want to be sitting in a checking account at the bank. Or I don't even know what the banks are paying for repos, but I'm sure they're not treasury rates.
Well, we've been getting about 4.5% on our checking account. So the town.
4.5?
Yeah, we realized we've realized almost $100,000 in interest already this year, just on our account. So, you know, that fund balance continues to grow, but I think we need to sit down and do a cash flow analysis and see what do we need for the next 6 months to a year, and then reinvest some of that where we could do a little better than 4.5%.
Right. Yeah, you could easily pick up an extra 100 basis points.
Yeah, I think we can.
No.
And so I'm happy to say that we're in that strong financial position right at the moment. And in terms of drawdowns, you know, the last couple of years have been pretty significant. We've had a lot of things we need to get done, but we've got those done. And at least for the short term, over the next couple of years, I don't know if we could stay within the 3.5%. But we're gonna be a whole lot closer to it than we have been.
Right. Well, that'll make a big difference. So here's a quick look at our top 10. Not these names are probably not unfamiliar, but again, at the end of the day, you want to look at some of these metrics. You look at the dividend growth here, 1, 2, 3, 4 columns over. Look at the total stock portfolio. The annualized dividend growth rate of the stocks in the portfolio, 17.8% against 6.3% for the S&P. These are really important metrics. Top 10 are double that, but that's a massive rate of growth on the dividend growth side, and you know that's going to benefit the portfolio in the long run. Total stock portfolio, obviously, again, cheaper. ROIC, again, you know, very important number. And the top 10, lower debt, 35 versus 47, and almost 14 on the ROIC. So characteristics are really strong across the board. I mean, Google, we all know, Microsoft, Berkshire, Visa, Apple, we're actually underweight. We've been underweight Apple. It's hurt us a little bit this year, but you know, it's an expensive stock. It's 27 times earnings now as of the end of September, but it was north of 30 times earnings when September started. So great company, great franchise, but we're a little bit underweight right now. And then Amgen's done well. Broadcom's have been a terrific company for us, MasterCard and UNH. That's it.
I guess so. Thank you for taking the time. I guess
Oh,
overall,
of course, anytime.
overall, we look at this and say, the council can handle it pretty well.
I think it's fantastic.
I'm sorry?
I said, I think it's been fantastic, the way this
No.
is going.
Well, I'm not gonna argue that point.
I wish that was my retirement fund that we were talking about. Right?
Well, this relationship is pretty special to us. It's, obviously it's a long-term relationship and we've always loved working with the town and we get a lot of gratification out of this relationship specifically because we're involved from the very beginning on the policy side and, 13 plus years, it's, almost 14 years. That's an impressive run. And, we've always enjoyed working with everyone in the town. So holds a special place in our, in our thoughts. So.
Well, like I said, Dan, once we get this latest audit completed so that I know, where the town's fund balance is and where we are financially, I think we can start returning some funds into this. Even if it is in something, as you mentioned, a separate account so that we can have access to it if we need to. But I'm very encouraged by the town's financial position right at the moment, so.
No, that's good. That's good to hear.
Yes.
Yeah, not a lot of towns have your financial optionality, so.
Well, the big fly in the ointment right now is Maine Yankee.
Right, that's right. They're appealing their valuation.
They haven't officially, but they have told us in no uncertain terms they intend to, so. And that certainly can affect my fund balance if,
Right.
winds up going through, but that's even still, that money's still sitting there and that this could be a multi-month process that we could be taking advantage of some higher rates on.
All right, well, anytime you want to sit down and talk about it, Dennis, and we'll, if you want to open up a separate account, and I mean, anything we do on the fee side will be de minimis, so it obviously won't be the same fee schedule as, is a little bit because we got to carry the things on our books and we got the traders are going to have to manage it from a cash management perspective, but we do that for next to nothing just to help the town out.
Yeah, no, I appreciate that.
All right, well, good to speak with everyone. Take care and, call anytime.
All right, thanks, Dan.
Thank you.
See you later. I'll be in touch.
Bye.